Okay, so welcome back, guys, to another lecture in our 2025 mentorship. So today we are going to be looking at what went through for the day. Today is 1st October. We are going to be looking at price action for 1st October. The New York session, we are going to be looking at the pre-market and then the opening bell at 9:30. So, drawing your eyes to the pre-market session starting at 7 a.m. First and foremost, what I would want to do on the chart, I would want to have the 12 a.m. 12:30 opening range. The 12:30 to 12 a.m. to 12:30 opening range is this yellow box marked here. Going into the pre-market open, I want to pull your eyes to that. The price action we have for the pre-market open. We have before 7 a.m. we have the market dropping lower into this volume imbalance right here. I want you to look at this. In this price leg, the retracement here, most of you would have to consider the whole of this as a bullish order block on the higher time frame, but on the lower time frame I would want to consider these two candles as my breaker, because the bodies of these two candles closed below these lows, so I wouldn't consider these black candles in here. I would consider these two. So in these two, where would I want to see the market remaining? It's above the last down close candle before taking out these lows. So I have that. If I'm to mark out this as my bullish breaker right there, bullish breaker block. I'm so tired. I just came back from school, but it's fine. So we have a bullish breaker right there, as you can see. But within this bullish breaker, how far can the market go when it comes back into it? This volume imbalance right here. So this is not random. This is price action printed for you to see, and basing on that to make a model. So after 7, if I'm to trade the pre-market session, most of the times I don't want to look at the sessions before 7 a.m. but in this kind of scenario, we didn't have any buy side or sell side ignited when 7 a.m. was opening. So we open up at 7. I want to take your eyes to this up close candle. So if I'm to have a breaker is, we have a low, a high, a lower low, and then a higher high. So this move here would be considered my breaker. This here, this move right here. So this would be my breaker right there. And in this scenario, we tend to be having, we have a low, the low of this candle, the candle goes back up forming our high, then we drop lower coming into the volume imbalance, then we have a higher high. So this is my breaker. And if I'm to draw quadrants on that breaker, if I'm to watch the upper quadrant of this breaker right here, this is our breaker, this is the candle that I was talking about, zoomed in. The market fails to close above the upper quadrant right here. You see, we have no closure above the upper quadrant. The candles that go above the upper quadrant all have no wicks, so that means this was manipulation. I'd consider all this as wicks. I wouldn't consider these closures. So the moment we have a candle that goes up and closes above the upper quadrant, the 0.75, we have this candle giving a volume imbalance and retracing back into this candle for the last time. So when do you know that this move is going to run? So within this is all noise. I only know that the candle is going to run because we have a confirmation, and my confirmation is the closure above the 0.75. I didn't consider the consequent encroachment because you can see where the reaction was coming from. It was coming from the 0.75, not the consequent encroachment of this candle. So after the closure, we have a volume imbalance, market drops down into the 0.5, and this would be your execution, the closure and the market dropping back into this candle, the open. So you would if you wanted to execute, you would execute at right there, having a stop loss below this candle's low. So if I'm to do something of that sort, yeah, so this would be your first trade. And what am I targeting? If I'm to have it like that, I'm having these highs right here. This is so evident, this is liquidity, and I'm having this high also as liquidity. And why am I looking for buys right now? Why did I say that this gap would work out, or this breaker? Just because I have the 12 a.m. to 12:30 opening range high above in price. So I'm looking at this as a draw on liquidity for my New York session trading. So that would be, and it aligns with this buy side liquidity and sell side liquidity. So if I'm to show you something, how far can the market go above this high? So I'm going to consider the start of the move, from the low to the high, and I would use the negative 0.25 fib level, call it extrapolated low and high. So how far can the market go above this high is the negative 0.25. So if I'm to take my profit target to that, you can see very well it is smashed before the market starts initiating a move for sells. So this is the safest take profit you could have, and it aligns above the consequent profit of this opening range at 12 a.m. 12:35. So that's how far that the market can go. And if I'm to venture deeper into this analysis right here, that would be take profit. If I'm to work with this price action right there, the market rallies higher into this. If you didn't take this entry at that, the market goes higher. If you looked at this as the breaker on the higher time frame, if you looked at that, we have our mitigation block. So the market goes higher, giving us a volume giving us an imbalance or an inefficiency. Well, in this inefficiency, we expect the market to be pushed higher, but how far in this inefficiency will the market react from this mitigation block right here? As you can see, we tap the mean threshold of it this week, half of that week, we tap it right there, the market rallies higher into the 12 a.m. to 12 a.m. opening range. So going into, so this is 7 a.m. trading, or rally higher, and this is a move higher. We take out sufficient liquidity. As you can see, we have these highs that we have formed in when the market was opening. So this consolidation, we take out that high, we go for these highs coming into this imbalance, rallying higher into this order block right there. Then I wouldn't want to look at post price action before. I wanted us to look at what happened in the market. So for this drop, I had some structure. First and foremost, we had rallied higher, we expected a move. Remember, when we take out external range liquidity, we come back for internal range liquidity. So we expect a move back into this range. So when is that move likely to happen? We use time and price. It is likely to happen at 8. You understand? So at 8 a.m. we have a move that comes back into the range. Now, where are my areas of liquidity in this range? Current range, I'm having an inefficiency right here that we had, and I'm having this low that retested into that inefficiency. So this would be used as my sell side right there. I would have it as sell side liquidity as that. Now, how am I to take this trade? This is the model I like most. I'm more of the optimal trade entry guy because that's what I studied most on ICT. I use these other confluences for other price, but studied the optimal trade entry, and looking further into it, it gives you an insight of when the optimal trade entry to have a scope, take an example of the move that forms the breaker. Remember we said have a high, a move that resists into this range, and then a higher high, and then a lower low. Now this would be our breaker. So from the low of the breaker to the move that takes out this high, if you put your fib like that and wait for the optimal trade entry, let me just put it on the chart. So if I'm having reverse, if I'm to have, oh my god, if I'm to have my fib from this low to this high and extend it further for every high that forms after this high, continuing into this high, I would want to execute when the market closes back below these levels at the closure here, and the market retests into that, looking for this as my dose on liquidity. And basing on that, we have this as a drop, we have a high as I said here, so this is these black candles, then we have a higher high. So from this high to this low of the breaker, I'm waiting for the market to go above that, drop lower and close below this level. So after the close here, the market goes back into that range, going to the 0.79. This is not random, this to the tick. Then after that, what happens? We drop lower into liquidity. So execution would be after the close and the market retesting into that range, something of that sort. And your SL is at the fib level, the 1 fib level. So targeting this, my first target as the partials here, then my second partial, symmetrical price aligns with this order block that retested into this fair value gap and these lows right here. So you would want to take either all off or leave a runner into this low, because you can't know when. We can either form an SMT with ES and leave this low open. So the best take profit would be at symmetrical price, and that would be an entry with the fib level. But if I was to use other ICT concept, I would wait for this breaker to form. When the breaker forms, it has a fair value gap. I don't expect the market to trade back into this fair value gap because of this breaker, so leaving this as a breakaway gap. Now this breakaway gap doesn't have to be filled. I would want that to be open, then we drop lower, coming into half of the opening range, right back higher into the consequent encroachment, then we have this big drop into that low. Now that would be 8 a.m. Further in price, we have a consolidation going into the opening bell. This is where I would want to look most, opening bell. So we have accumulation. If you're versed with the AMD model, the Enigma model, we have accumulation, which results into second degree accumulation, manipulation and distribution model. So we have accumulation, we manipulate, and then we distribute higher. Now the reason for this accumulation is to trap buyers into the wrong bias, and then we manipulate their orders, making those that had the right bias to neglect their bias of buys, thinking the market is going to continue selling, and then we rally higher. So this is what we had here. We had the whole of this as accumulation, starting off at that, going into the whole of this was accumulation. The whole of this range was accumulation. We drop lower, 930 open, we manipulate, taking out this low that took out this low, and then we have a move higher, we distribute higher. After this distribution, and I know now the market has lost this arrogant moves are over, we have an accumulation again. What would I want to do? Again, back to my optimal trade entry model. I'm looking for a move that would cause the breaker. So I have the low, and I'm expecting any move higher than this is where I would have my high at. So if I'm to have from this low to first this high, when this candle comes and takes out that high, my fib is at that. This high is taken out again, my fib is at that, until I have a candle closing below. We have a candle closure below. This would be my entry, this candle right here. So something of this sort, short position right there, and my stop loss would be at the 1 fib level right there, targeting what? Targeting sell side. Sell side is at that low if I was to have this move. So we come back into that, we'll trade into it again, and then after the market takes out this low, I wouldn't want it to come back higher into this range. The moment the market takes out the breaker, then I wouldn't want it to come back into that. Now we drop lower, clearing this low. So why did I think of sells right here? Referring to 2024 mentorship, the collapse model, if we are to sell, most of the times we are going to first take out what? Sell side. And what happened? We took out sell side in this move, then we came and cleared buy side. So I would only expect what? Sells in this situation. I wouldn't want to continue taking the market higher and higher. And if I'm to add the new day opening gaps, we managed to surpass this, we close above it, and the market rallies higher into these new day opening gaps, and it fails to leave a body closure to show an intent of inversing them. So this all gives me confidence that we are going to drop lower. Dropping lower into what? The new weekly opening gap. Yeah, we'll drop into the new weekly opening gap, and as you can see by the tick, we have the market dropping into the new weekly opening gap low. So if I'm to do something of that, so this is the new weekly opening gap. The market, after it taps that, we have a rejection immediately. Okay, so that would be the 9:30 opening bell. If I didn't use the fib, same thing, I would wait for the breaker here, or looking into the consequent encroachment of this new day opening gap right there. We fail to close below it, we fail to close for the whole of this. Is our all manipulation. Wicks are manipulations. The moment we close below the new day opening gap, that would be my execution when we come back into that range that failed to close below, and we drop lower into that low. So that would be it. Taking this off, going into the 10 a.m. everything is based on time and price. Going into 10 a.m. we take out this low, we have we have the market going back into this fair value gap right here. As you can see, that fair value gap, if I'm to zoom in, this fair value gap, I want your eyes to be pulled to that. The moment we take out the liquidity that the market was hunting, we left a fair value gap, and the market comes back and inverses it. After the inversion here, we come back into that another time, then 10 a.m. opens, rallies higher, giving us this move lower. Now, as you all know, as I said, so when the market is opening, we expect accumulation and manipulation, then distribution. So 10 a.m. is the open of the new 4-hour candle. The 4-hour candle opens at 10 a.m. we accumulate, we go higher, we come back lower, we drop lower into this inversion fair value gap. The wicks manipulate, giving us a mohawk here, coming into this order block, giving us this manipulation move. So we have, on the 4-hour time frame, we are having something of this sort. We are having something of this sort, me see. On the 4-hour time frame, we're having a candle as it comes back bullish. We have a body and then a wick. So this is the market taking out sufficient liquidity, and I do not expect the market to come back lower into this. We expect the market to rally higher, to continue higher. So that's the expansion we expect. After dropping lower into that, take note of the 12 AM opening range. The bodies respect half of it, and we come and close back above the 12 AM opening range. We close above that after this manipulation. So I'm expecting higher prices. And looking into that, we also have this fair value gap right there that was inversed also. This is an inversion fair value gap. That inversion fair value gap also, we close, the next candle comes and closes above it, then this would be your execution. If you had to take a low risk buy, now my stop loss wouldn't go all the way below this low. I would have multiple areas of my SL. I would have, first of all, these bodies. I wouldn't expect the market to drop back lower into these bodies. If you feared that, the low of the inversion fair value gap candle right there, and then if you feared that we had half of the 12 AM opening range below that, and also if you feared that we have a wick right here, we expect half of this wick not to be taken out. Even if the market drops lower into this wick, we expect the upper portion of this wick to have strength, pushing the market higher. So if I'm to put my fib from that low going into the body of that quadrants, I would have, if you feared that, I would have this as my stop loss, looking for higher prices into what? Having equal highs. We're having highs right there. We have an inefficiency into that. That's how far the market has rallied. And then if you did not take in accordance of these highs, we have this high, and I told you if you are to measure how far the market can go above that high, I'm going to put the negative 0.25 extrapolation right there. So this would be your take profit according to what we have studied so far. According to what I have given you so far, this would be your first take profit, not going into this choppy price action. So this would be the most ideal take profit. So thank you guys, that's all for today. I hope you have a nice time. See you in the next video.